So a couple years ago, I was talking to a DIY investor and I asked them what their plan was for RMDs, and their plan was illegal. See, their plan was to convert their required minimum distributions to Roth. This is a big no-no. You can't do it. And if you do it, you're going to be penalized. So today I'm going to show you what that looks like if you want to continue to do conversions as you reach RMD age. And I'm also going to show you why you should not follow this DIY investor's lead and wait before you start converting to Roth. So let's jump in. Let's say you reach RMD age and your RMD is going to be $40,000. Well, the gentleman before, he thought he could do a Roth conversion of $40,000 so that RMD, sure, it comes out of the IRA, but it's going from, this IRA bucket to Roth bucket, and it's going to now grow their tax-free. And the answer to that is no. You absolutely cannot do that. Your RMD cannot stay inside of a tax-advantaged retirement account. You can only pull it out and pay the tax on it. You can reinvest it. You just can't reinvest it in an IRA unless, of course, you have ongoing income, but then it's still kind of two transactions. Now, what you could do, what this would actually look like is you'd have an IRA distribution of $40,000, and if you wanted to convert on top of that, you could. But instead of $40,000 taxable, it would be, let's say, $80,000 taxable. So you have to decide if that actually makes sense. Now, it could make sense. I mean, let's say that here's the tax bracket you're in, and here's the threshold for the next tax bracket. Let's say your RMD takes you up here. Well, it's possible that a Roth conversion makes sense to fill up the rest of that bracket, and you would just continue to do that. But it's very important to realize that you absolutely cannot convert your RMD. So if you put money into a Roth that you're not allowed to do, you're going to get penalized on that money. So you have to fix it by year end if you happen to do it. So a much better strategy, let's say this is age 65 and this is, I'm going to say 75 for RMD purposes. A better strategy, if this is your income leading up to 75 and then the RMD is going to bump that up in here, well, it makes a lot more sense to me if you can find a way to convert and fill up in this bracket before you reach RMD age. You're going to pay hopefully a little bit less tax on that money, and then maybe you even get this to stay once you hit RMD age. Maybe you get that RMD level to stay in that bracket. Now, I'm not getting into specifics on where the bracket might be, but that's the strategy that I want you to be looking at, is be proactive. Don't wait until you reach RMD age to try and solve the RMD problem, because it might be too late. So this is an example of someone who was a really good DIY investor. They had really set themselves up well, but when it came to tax strategy, they really needed a second opinion, a second look, just to make sure that they weren't about to make a very costly mistake, because those penalties would have really racked up over the years had the IRS caught it. If you're a DIY investor out there needing some help, go check out adviceonlynetwork.com. You can find a list of advice-only financial planners there who do not manage investments, and they have different models of charging, whether it's hourly, by project, whatever it may be. So go check out adviceonlynetwork.com if you're a DIY investor who needs some help on the tax planning part of things. If you enjoyed this, do me a favor and subscribe to the channel. Give it a like, and maybe share the video with a friend who might be approaching required minimum distribution age. Until next time, have a great rest of your day.